My name is Mark. I'm the founder of the geometric trading model. This model is used to determine the entry and exit points for financial instruments that are traded on an exchange. For example, stock prices, commodity prices, bond prices, all financial instruments that are traded on an exchange. The difference between this model and the existing methodologies out there is that this uses sacred geometry to determine. And with that, we are focusing on the underlying process that gives rise to the price changes that we observe in the market. Whereas the current methodologies, they focus on the actual price trends to try and determine when you should buy or sell. Whereas with this model, we are focusing on the underlying process. So in trading, the underlying process is the interaction between the buyers and the sellers. Okay. So what inspired me to create this model? So when I was studying for my MSc in Mathematical Finance, where we learned how to build models to price various financial instruments, I found that the methodologies that we were using, there was not a definitive model to say, okay, this is the correct model. Everyone had their own piece, to say. Then I found an opening there, and I felt that I could actually come up with something that is different from the current methodologies. So that's where my journey started, just out of interest to say, okay, because I have a passion for mathematics, so using mathematics to solve real life problems, and that's what inspired me to look for a definitive answer to this model. So I got an insight from Spirit of how universal laws work, and that these laws can also be applied to financial markets. And this is based on the principle of balance. Everything needs to have balance. And with financial markets, these are variable systems. So they'll vary, but at the end of the day, they will want to maintain a balance. So from these, that's where I got the insight to say, okay, if we then look at normal systems, like leaf, for example, or the structure of a human being or anything else that exists, it has a structure to it. And that's the insight that led me then to come up with the model based on structure. And this is the fundamental difference between this methodology and the existing methodologies that are out there. Okay, so during my work experience, when I was working for Multiserve Group, I was based in Leatherhead in England. I had an opportunity to work on a mathematical model for designing a crusher for one of our systems. So all that experience and insight has actually helped me to develop this model. I have over 30 years of work experience. I started off my work experience as a process engineer. I've worked in various fields, in the chrome industry, in the steel industry. I've developed models for metallurgical accounting. I've developed a model for a mathematical model for a crushing system, and various other data analysis. I've worked with risk management as a quantitative analyst, developing risk profiling of models for funds. This was when I was working as a consultant with distribution technology in Reading, England. I worked on the development of a mathematical model for a crusher. This was when I was working as a development engineer for Multiserve Group in Leatherhead, England. And I also worked on metallurgical accounting systems when I was working for Zimalois in Zimbabwe. So I have quite a wide variety of experience within the engineering field and also within the financial markets as a qualitative analyst, where I was assistant fund manager for the UK Growth Trust when I was working for WH Ireland in Manchester, UK, where I assisted the fund manager in picking stocks for our fund and also developing asset allocation models for our fund. And then I also worked for distribution technology as a senior quantitative analyst, where I was working on a project for risk profiling of funds, developing online calculators for pension funds. So I have quite a broad range of experience, and this has also helped, this assisted in me in coming up with a definitive model. So financial markets behave like everything else within the universe. What goes up must come down, and what goes down must come up. Everything vibrates, and just like stock prices or commodity prices, they all vibrate. So you can't lose in that case, because once you determine where the end point, where the turning point is on one side, and then you determine where the other turning point is, it's bound to go that way, because that's how everything works. Everything is vibrating. And with financial prices for instruments, these are varying every single day. They are vibrating. So when it goes, so it's just a matter of determining where the entry point is. If it's at the bottom, it's going to have to go up. And if it's at the top, it's going to have to go down. Right. Why you don't lose using this trading strategy? The unique difference with this trading strategy and other trading strategies is that this one is based on structure. So when we are looking at structure, we are not, in this model, we are not predicting the price of an instrument, where it's going to go. No, we're not. All we are doing is we are predicting the change in direction of the price process. So from when it's coming down and starting to go up, that's our entry level. We can accurately determine that. And again, also when it's coming down, but the main point for trading is the entry point. So we can accurately predict the price change, the direction of change. So I'm basically here to bring relief to traders, because using this trading strategy, you can now trade at ease. I'll give you an analogy. You've got your little one is busy licking their ice cream cone, and you're crossing a busy street. Your little one is only interested in that daddy is holding the hand, and the little one is just busy demolishing that ice cream cone. And this is the same thing. The blue line, your indicator, that's your hand that's holding you as you crossing a busy street. That's how the relief that I'm bringing to traders. So now anyone can trade and make profits quite easily without even having to make a stress. So if you're looking at these charts right now, here is an entry point. Position level 2, you buy there, you hold your stock until you reach there, you can sell. So normally with that we enter here, level 4 and below we enter, and then levels 8 and above we sell. So from there, that's your price, entry point there, that's your price there, your first exit point is there, that's your price will be around there. If you held on longer there, your price around there, and you've made your profit. Easy. And then you wait for this indicator to come back down to buying territory before you re-engage again. So simple. So that's relief I'm bringing to traders. Trading has never been so simple, because with this is the easiest way that anyone can ever trade.